Hi everyone, hope you're all doing well out there. Time for one of my most popular video series that I do on the YouTube channel, which is the UK stocks I'm buying November 2023 edition. And this is where I'll go through the UK stocks that I bought and sold between the 1st of October to the 1st of November. So anything that I've done in the portfolio will be on here. I don't hide my buys, I don't hide my sells. There's a couple of YouTube channels out there that will, if something goes wrong, they'll quietly sell it out in the background and hope you don't notice. Doesn't happen on here. I talk about what I'm doing in the market, full transparency. So I hope you enjoy the video as always, guys. And if you could, hit the like button. If you're new around here and you find the video helpful, subscribe. Let's get started on these stocks. But before I do start the video, if you do want to support the channel, join the Patreon. £5 a month and you get 2 exclusive videos a week on there. You also get my live buy and sell alerts, and as well as that, there's a Discord with 500 members on to talk about stocks as well, including me. Best way to get hold of me is on there, and you'll be able to see the exclusive content like this. We dropped the US portfolio review November 2023 edition last night, so you can go check that out and see how my US portfolio is doing after the rally in Hims and Hers and DraftKings. And as well as that, if you do want some free shares, join Trading 2 and 2, link in the description, get a free share worth up to £100. Let's get stuck onto the stocks that I am buying. So Card Factory, I did buy some Card Factory. This one is a bit of a funny one. It seems to always have a dip now and then in the share price, even though the stock has been absolutely smashing it on the financial point of view. And you can see here, actually from September, the stock was above £1 a share, and then it did have a bit of a dip down, as you see here. It was down nearly 20% here. And as it had this dip in the middle of October, which came off a really good financial report, I thought, you know what, I'm really happy how this company is smashing it at the moment. And as well as that, 6 times earnings, I still think is a good valuation. So I did buy in this dip here. Since then, it has had a bit of a rally up. It has recovered from that dip, which is okay, but if it ever does have one of these dips here, I will buy some shares again in Card Factory. It's a stock I've held now for around about 3 years, and I am up a lot on this position, but I'm still very happy with the fundamental performance of this business. And as always, you know, I want to make sure that I don't just water the weeds and cut the flowers. I want to make sure that if I have a stock that's absolutely smashing it, well, you know, why not buy more of it? I do not mind averaging up on a position that is absolutely smashing it, because at the end of the day, the upside is just getting more and more. Card Factory, I'm sure most of you guys are aware of this, that are watching this from the UK. It's a company that sells greeting cards, gifts, gift wrap, or wrapping paper, balloons, maybe some other party accessories there, and it's more of a budget kind of play. You know, when you look at greeting cards, quite a few places do greeting cards for, you know, £2, £3, £4. Card Factory, you know, what you're paying £1, £1.50 for a card. It's a lot cheaper. And at the end of the day, even though there's all this kind of fear around a recession, people worrying about spending, people are still going to go out and go buy them birthday cards. They're not going to pull back on it. And if anything, rather than going to Moonpig and paying £4 for a card, you know, a lot of people are going to Card Factory, where it's definitely a lot cheaper, and people are still want to go get people, you know, a nice you know, birthday card, Christmas card, whatever it will be, as it's you know, people appreciate you getting them through the post or getting them delivered when it is your birthday, for example. Like I said, the stock did dip during the month of October, where I picked some shares up. It came mostly off the interim results, which was really strange because the interim results were amazing. Like, the stock should have been up. Group revenue up by 11.5%. You know, a double-digit growth here from a company at 6 times earnings. I know, it's absolutely crazy. Like-for-like sales growth of 10% as well. They obviously have been investing into the partnerships, opening up more partnerships as well as the stores as well. And obviously from a profit point of view, the profit as well was fantastic. So if you look here, profit before tax growth of 10.4 million, and that now was up to 24 million, which is very good. The balance sheet as well is getting stronger as they are paying off more debt. So if you do look at it from a financial point of view here, you can see here the growth of revenue and the growth of profitability that is really kicking on in this business. And for 6 times earnings as well, it's not too bad at all. Financial health wise as well, like I said, the big issue with Card Factory before the pandemic was the debt around the balance sheet. And for Card Factory, the pandemic was a blessing in disguise. It was able to sort out its balance sheet, pay a bit of debt down. So you can see here the debt to equity was nearly 86% in April 2020. Now it only sits around 34%, which is not too bad at all. So that balance sheet has really strengthened up. Part of it was not having to pay out a ridiculous dividend as well, which was a little too high for the company. So they gave excuse to cancel it. You can see here that they are sitting on a a lot more cash here. I'm just looking here, this is actually the wrong balance. The Simple Wall Street a little bit slow to update here, 98 million. I believe it's a little bit lower, yeah. So you see here it's actually 71 million. It's a little slow to update there. So it's actually, the balance sheet is even better than what it is on here. So you always got to be careful with Simple Wall Street sometimes, can be a little slow to update. But the dividend is going to start coming back, and obviously we should start picking up a very good dividend. Obviously if you go back to the old dividend, I mean that was like, you're getting a 10% dividend yields here, but obviously they're probably not going to go back to that, but you are going to get as well a nice dividend more than likely now the balance sheet is strengthened up in 2024, which is good. And from an insider point of view, insiders are buying shares. Darcy Wilson, the new CEO that came in, I think it was about 2 years ago, he might have come in now. He's done a fantastic job. Also was picking up shares around the 91p range, which isn't too far off where it's right now, which is obviously a very good positive. The next one is Darktrace. So Darktrace, once again, was a stock that had a bit of a wobble off an earnings update, and I thought the earnings update were very good, to be fair, so I don't think it should have had the wobble. You can see here that the stock from September time, once again, very much like a card factory, had a dip through October, had about a 20% dip there off its earnings. Since then it has started to have a bit of a rally up, and I took advantage of the dip and I bought into Darktrace. It's a stock that I've held for around about a yearish now. I started buying in this dip when there was a short report which was just loads of bad allegations made against the company. The company responded, kind of took apart the short report. They then actually committed a good buyback into the stock because they had a very good cash balance. And also, as a third point to counter the short report, the CEO actually bought a ton of shares as well, and I thought that's absolutely amazing. That's really good management. And looking at the share price, I thought, you know what, I'm going to buy some shares here because the valuation does look really attractive, which I'll show you in a second. It's a very good growth company in the UK, which we don't have many of. It's trading at 50 times earnings. I think realistically it's actually around about 47 right now, but we'll let it go a little bit. So Darktrace, I'm sure most of you are aware, Darktrace is a cyber security company, so they help companies avoid cybersecurity attacks, which is massive at the moment. Obviously, companies don't want to have their customer base worried about that their data has been leaked by them, lose a little bit of respect in the customer base. So they are a company that helps businesses get cybersecurity attacks and data leaks. This is going to be something that it's been happening more and more recently, and it's going to be a market that grows massive in the next 10 years. And that's why I bought Darktrace. I looked at Darktrace, thought it's probably the best valuation at the time. Obviously still now it's not too bad. I keep averaging up. I'm up I think about 30% on this, and I keep averaging up on it. So it's still not too bad right now, but it was a bit better when I did originally buy a big chunk in the position. But obviously cybersecurity as a whole is going to keep growing. I mean, if you look at the moment, the market size here is 1.3 billion, and it's going to go from 1.72 billion to 424 billion in 2030 with a CAGR of 13.8%, which is absolutely insane growth. On the last earnings report, I thought there were really good numbers. Obviously, a few companies have been a little bit cautious about the spend at the moment because they're worried about a recession, but even though a few companies have been a little bit cautious about the spend, it still did not stop them from putting in revenue growth of 28%, and also from a profitable point of view as well, it was good. The revenue growth for the year-over-year growth is now going to be 22 to 23%, which I think is good. Adjusted EBITDA margin of 17 to 19%, and free cash flow is going to be to 50 to 60% of the adjusted EBITDA range. If you look at the company, they've got a very good track record of the profitability and the revenue going up, as you can see here, which is great. And like I said, a lot of these kind of companies get valued off free cash flow. Now it is going to have a little bit of a dip in 2024, but it is expected to go back up to 148 million, which obviously when you look at the market cap at 2.3 billion isn't that bad of a free cash flow to market cap. Even at 70 million, you're not paying that much of a premium compared to a lot of other companies out there, but obviously that should expand going forward, and the growth is still very good at the moment as well. Like I said earlier, the balance sheet is really good as well. That's what made me really attracted to Darktrace. There was no debt on the balance sheet, and they did sit on 358 million of cash. Obviously as well, they're going to be ramping up that profitability a fair amount as well, so there's going to be a good bit of that profitability going to the balance sheet, which should be good as well. Like I said, it's a CEO and founder-led company, and as you can see, this is when the CEO did actually pick up some shares inside the company, which was very good. Since then, there has been an individual that has sold some shares inside the business, but you can see what I was mentioning about the sign of confidence that the CEO gave at the time by buying in that dip. Anyway, so I did pick some shares up in Darktrace because I really want to make sure I have a cybersecurity play for the next 10 years. Next one is Mobico on National Express. I did pick some shares up in National Express on Mobico Group. I wasn't going to do it, and then I looked at what the share price has done and I went, okay, I am going to buy some shares in Mobico Group. It says here they are going to pay 11% dividend yield. That dividend has now been cancelled, which is, to be fair, is the right thing to do. I think they need to make sure they get to profitability and get that balance sheet a little bit more healthier than where it is right now. I always said that this is what they should do, and it took them a while to make the right decision, but they have made the right decision. The stock is going through a few troubles around the profitability at the moment, but even though it's going through the few troubles around profitability, I think the share price has gone a little bit too ridiculous at the moment and gone way too low. I mean, it's gone way below where it was on the CV times, and that's when it wasn't even operating. And if you actually look at the share price point of view, it's somewhere where it was around, it's actually further, I didn't actually realise that, it's actually lower than where it was in the great financial crisis, which is absolutely crazy. And if you bought from there, obviously it was a good performing stock excluding dividends, and I think we could see some good share price performance from Mobico Group. Obviously when you look at the company, obviously a travel company managing coaches, long haul travel through transport, and also other things in other countries like trains, for example. If you look at the recent quarter, it was okay. They did a Q3 trading update on the 12th of October. No issues with the growth. The growth grew 10% year over year, and in fact, the growth is actually higher. The company is now on a revenue basis a lot higher than where it was before the CV times. The only issue is around profitability. The profitability is taking longer to recover. Now, they are expected to still this year do 175 million to 185 million in EBIT. Now, if they do them numbers, obviously that should be pretty attractive, considering that will be around about 2 times to market cap to EBIT, which is insanely low. You know, you talk about a company there that is getting priced for bankruptcy levels. So if they do that, then obviously the market will be proved wrong and this stock will rally off that. That's the big thing. A lot of people think they can't do it at the moment, and that's why it's getting priced so low. But if they do it, obviously the share price will do very well here. And the big thing is that they got to ramp up the profitability. That's not what they haven't been able to do at the moment. You know, higher costs, higher wage increases, so they've got to manage those costs, and they're doing things like increasing the prices to counter that. So that's the big thing that we are looking for. If I actually do show you on a past performance basis, you'll be able to see here the revenue and how much it's higher before 2020. So 2.7 billion in revenue, now it's 3 billion. So the revenue has done well. It's the profitability. We've got to see them get back up to a 3, 4, 5% profit margin. I mean, if you look at before the CV, if you look at March, I mean, they were doing March 2020, obviously a few kind of impacts from the CV coming in there, as you can see, but even then it was a 2% profit margin, and they did 61 million in profit. Obviously, if they were to do that now, that would mean the company's trading at 6 times earnings. Even before that, I mean, they're doing 141 million in profitability. I mean, if this company even gets to 50 million profitability, then this will be a winner for me, but obviously they've got to prove it to the market, and if they do it, then obviously it will do very well. If they don't do it, it won't do well, so we'll see what happens. It depends if you've got the confidence that they can do it. A few people worried about the debt on the company. I mean, a lot of it is fixed at the moment, so it's not too much of an issue, and they have always had a high debt load, really. You know, it's not easy buying trains and coaches and everything like that. And the big thing is that, you know, the assets that they have, obviously they've got a lot of assets as well, so you know, you can add that into, like, if, you know, worse happen, you know, there's a lot of assets that could probably sell off. But even with the debt balance, they do have, you know, they do sit on 350 million of cash, which isn't too bad at all. So yeah, been buying some shares in Mobico Group, which I didn't think I'd do, but I just got to the point of view where I was like, okay, I'll just buy a little bit more. Next one is JD Sports. So JD Sports hasn't had any trouble around the profitability. These guys have been absolutely firing on all cylinders. So this P ratio is not correct. It's actually around about 8 or 9 times earnings. So that's incredibly low. Like, this should be trading more towards 14 or 15 times earnings, which is crazy. It does pay a little bit of a dividend yield, and the share price has had a fall at the moment, as you can see here, down 28%. And it is kind of getting towards prices it was at. It's actually lower than where it was in 2020 before the CV dip, which is just insane. A lot of it is being caused by Foot Locker, which is a company in the US. These guys have been struggling financially, and for some reason people are taking it out on JD Sports, even though they've come out and said, like, we're seeing no issues, we're absolutely fine, which is crazy. So I'm taking that dip in JD Sports. I'm sure most of you guys know they are a retailer that sells a lot of shoes, clothing, men's, women's, kids. I'm sure you've seen them on the high street in the UK. And also a lot of their success at the moment is coming from expanding into the US, which is doing very well. On the recent update, as you can see here, the company talks about how well they're doing. So if you look here, organic sales growth of 12%. And profit on track for the full year in line with our plan. Growth has been driven by our premium sports fashion business. And if you actually look at the company here, so I mean, yeah, these guys, this Super Wall Street haven't got the updated piece. So if you look at January, they'll do about 700 million in profitability, which puts them about 10 times earnings. That profitability should keep ramping up, as you can see here. The revenue as well, obviously should grow at a good nearly 10% clip. So you're going to have a company that's going to be dragging up profitability and the revenue as well. And from a financial point of view, I mean, if we just look at how much ahead of where they were before CV they were. So if you look at CV before CV, when the price is now down 18% since that time frame, revenue was 6.1 billion. Now it's 10.4 billion. From a profit point of view, they were doing 246 million. Obviously by January they're going to be doing 689 million, so that's nearly tripled. So yeah, it just really doesn't make sense for this business to be this low, really. Financial health wise, great balance sheet as well, only 4.6% debt to equity. They do sit on 1.4 billion of cash as well, which is obviously really good. It's only about 20% of the market cap that they've currently got here. From an insider point of view as well, the insiders are loading up shares, so they're saying that they think the stock is pretty cheap at the moment. So yeah, I think that this stock is just, I don't know why it's so low. I think it's getting punished off Foot Locker, which is just really unfair to it. The next stock is Alphawave. So I did buy some shares in Alphawave. So this is kind of my semiconductor play into an industry of growing AI, 5G. So I've been buying some shares in Alphawave. Once again, a UK company that is I think a bit ignored. You know, Darktrace is ignored on the cybersecurity front. You look at some of the US stocks that are doing similar numbers. They're trading at a really big premium compared to them. I look at Alphawave. I think they're trading at a massive discount compared to its competitors, and even though it's doing quite well at the moment, so the stock has had a rough kind of couple of years since it did come onto the stock market, but recently I think they've really been sorting the act out. And I look at the CEO has a very good track record in this industry. If you've never looked at the CEO's history, it's very good, so that gives me a lot of confidence. They do silicon IP, which has been the main business, and then they've been expanding into chiplets, custom silicon and connectivity products. So if you do look at the company from the history point of view, you can see here pre-IPO a lot of the IP licensing here, and then you can see here they're starting to launch now their custom silicon and their connectivity products, which is going to really ramp up the revenue and profit hopefully in the next few years as these get bigger and bigger. They have major partners as well. They've got major partners like Taiwan Semiconductors as well. And even though the company is dipping out profitability because of a lot of acquisitions they have been making, when we get towards the back end of the year, we should see the company putting around about 60-ish million of profitability, which once again, that will put the company around about 12 times earnings, which I think is just way too low for a company that is going to do the financials they're forecasting to do. Obviously, it looks like they're going to have very good growth. We should see growth of nearly around 20%, and the profitability as well should be dragged up more and more as we go on. Hopefully, we see the company getting towards nearly 100 million in profitability in the next 2 years, which would put it around 7 times earnings, which I think is way too low for a company that is going to be growing around 20%, as you can see here. Financial health wise, not too bad. I wasn't the fan that took debt on for the acquisition, but maybe it was an acquisition they had to make at the end of the day. So yeah, that's the only little downside that's recently happened, but they still sit on 122 million of cash, which isn't that bad really. And from an insider front, there has been quite a few insiders buying in the last couple of months, in the last 12 months that is. So yeah, I have bought Alphawave. It's kind of my exposure into the semiconductor space for the growing AI demand, 5G and everything else that needs semiconductors. The last stock that I bought was Forterra. So Forterra is a stock that's been punished because it relies on construction, obviously supplies building materials, bricks, the London brick, and obviously at the moment interest rates are high, so construction has slowed down, and obviously that's affected the share price here. Now I have been buying some shares in Forterra. I think I'm around about down 18% on this one, which I think isn't too bad considering when you look at the share price, how much it is down, I could be a lot more down than this. Currently trades at 8 times earnings on the current numbers and an 8% dividend yield. Obviously, these numbers could fluctuate a little bit because obviously the sales are slowing down, so that could go a little bit higher. The dividend yield maybe gets cut if the sales do slow down a lot. But in the longer term, I think obviously we'll see housing, building recover, and what will happen is I will get some share price appreciation and they will go back to paying a dividend. So I think I'll be okay in the longer term. It looks like we may be getting towards the peak of the fear in the market now. I personally think we'll see the UK housing market bottom in the next coming 6 to 12 months, and I think obviously, as we always see, stocks will rise before it's clear that the worst has passed. So realistically, we could probably see the UK housing market stocks maybe start recovering in 6 months' time. But yeah, obviously Forterra, they've made some expansions into new factories that will help them produce more materials, and obviously that will hopefully make the revenue higher and the profit higher in the next few years as we see the building and construction industry start to recover. That's my big investment case on it. When you do look at the growth, they do have a good track record of growth. Obviously you can see the slump at the moment in the financials, but we then should hopefully start to see the profitability and the revenue start recovering inside the business, and we should see some improvement there as well. Financial health wise, what makes me a little bit happier to buying it is that it seems okay on the balance sheet. I mean, 31% debt to equity, they do have 66 million in debt and they do sit on 16 million of cash. When you do look at inside the company, my only downside is that I don't see insiders buying, which I would like to see them buy considering how low the share price is. So something that I would like them to work on there, but I did nibble some shares in Forterra anyway. So that's the last stock that I bought. There was one stock I sold. I did sell 1/3 of my position, and the stock that I did sell for about 1/3 of my position was Boohoo. I did sell 1/3 of my position off in Boohoo. I have kept the other 2/3 just because I think that I'm going to give them a little bit longer to start showing some improvement, but unfortunately I said that if they don't start showing improvement soon, I will start releasing some shares, and they haven't shown signs of improvement, and I am a man of my word, and if it's not happening, I've got to make a decision where I can potentially recover the loss, some of the loss that I did take on that investment, unfortunately. So I'll give them a bit more time with the rest of the shares. I'll probably decide in 2024 and see if there's any sort of improvement that hopefully that can recover. But yeah, I've just been not happy with the performance in Boohoo. I've said on for a while that I'm not happy with them, especially on the video that I made on the last update. I feel like they need a new CEO. The CEO has not done a good job since he's come in 2019. I don't know where the company's going. If they're staying on this e-commerce route they're currently on, I think they're going to lose badly to Shein. So that, in my opinion, I would be, if they're going to go down this route that they are doing at the moment, they need to get their supply chains all across to China, and then they can be a lot more price competitive to Shein. I think the whole designers need a complete revamp. I think the designs have been very poor. Obviously obviously one big thing if they're not selling products is that maybe it's not cheap as Shein, but as well as that, the designs are clearly not good enough as well to make people go buy them. And ultimately as well, I think if they are going to stay in the UK, I think if you are going to stay in the UK and you are going to have your manufacturing from the UK, you're never going to be able to compete really with Shein. So the only other way to go compete is on the high street, where if you have the same sort of levels from as Primark, Primark's shown to be a successful business. If you can have the same sort of pricing structure or even cheaper, then you're just relying on your designs to be better than them. So Primark have proven you can do it from a UK point of view, but that's how you do it. I think if it's going to stay online, I think unfortunately they're just going to get crushed to Shein, and if they keep doing the same thing and expect different results, it's not going to happen. They've got to rotate the business model somehow, and unfortunately, like I said, I think the CEO has been poor since he came in 2019 and hasn't done a good enough job, and clearly when I look at the business, he just keeps saying the same things and expecting different results, which is just insanity. So I obviously time to release some capital off there. I'll give the rest of the shares 2024, but probably when we get halfway through 2024, if I see no improvement again, that'll be the next chunk gone, and then probably at the back end of 2024, if I don't see any improvement by another year's time, that'll be me totally out. I always said that I can't give Boohoo much longer, and I can't just sit there and pray. As an investor, if you're just sitting there and praying, it's not good. You don't want to sit there and pray and hope for the best. You've got to make decisions, even if it's a painful decision. I've got to maybe cut cut the losses and go find another opportunity where I can at least make up some of the money that was a loss on this one is what I've got to do. So yeah, I've started to act on Boohoo, but obviously for the rest of the shares I'm going to give it a bit longer anyway. So those are the stocks that I'm buying and selling in November 2023, guys. I hope you enjoy the video. If you could smash the like button, it does take me a good few hours to put these videos together, so if you can show it some love, that's absolutely amazing. And yeah, thanks for watching. I'll see you in the next video.